Welcome back to The Edge, the podcast where we cut through the noise and talk about what really drives financial success. I'm your host, Postname, and today we're tackling a sobering statistic, the fact that roughly 90% of retail traders lose money over the long term.
That's right, hostname. It's a statistic that haunts the industry. But what most people miss is that it's not a secret formula or complex indicator that separates the 90% from the consistently profitable 10%. It's something far more fundamental.
And that's exactly what we're diving into today. Our topic is the Digital Trading Journal, which sounds like a simple spreadsheet, but as our expert guest name is going to explain, it's actually the ultimate roadmap to profitability. Guest name, thanks for joining us.
My pleasure, hostname. I'm excited to demystify this. If you think about it, no Formula One team sends a car out without logging every single metric. Tire pressure, fuel, lap times. Why? Because you can't optimize what you don't measure. In trading, your account is that F1 car, and the journal is your engineering team.
Context, why the journal matters. That's such a powerful analogy. Let's set the context. Why is this topic, something as seemingly mundane as logging trades, so critically important in today's fast-paced, highly leveraged digital trading world?
Well, the market gives us instant gratification and instant pain, but it doesn't give us instant data. The 90% fail because they approach trading like gambling. They rely on gut feelings, watching the screen, and hoping. The professional, however, sees it as a statistical game. If you don't have a data set of your own performance, you cannot prove that your strategy has an edge.
So it's about applying the scientific method to your finances, right? You need testable, measurable data.
Exactly. You need to be able to answer questions like, what is my success rate on the Euro-USD pair on Tuesday mornings? Or, do my trades perform better when the volatility is high or low? If you can't answer those questions with cold, hard data from your own execution, you're just throwing darts. The journal is your R&D department. Giants like Apple or Google spend billions on R&D to gain a competitive advantage. Your journal is the core investment in your personal expertise.
Core discussion, essential components. So let's get practical. For a listener who's currently using a basic notepad or just a few columns in Excel, what are the essential, non-negotiable components of a truly professional digital journal template? It sounds like it needs to capture more than just win or loss.
Absolutely. A professional journal must capture 3 dimensions: tactical, technical, and psychological.
Walk us through those. Let's start with the tactical metrics, the hard data.
These are the skeleton of the log. Beyond the obvious date, asset, and P&L, you must log your initial stop loss, SL, and take profit, TP. This is crucial because it logs your plan, not just the outcome. You need to know if you followed your own rules. And always log your P&L as a percentage of your account. That standardizes your performance regardless of how your capital grows.
That makes sense. The percentage tells the story of the strategy's health, not just the account size. Now, for the technical metrics, this is where the real strategy analysis happens, right?
This is the gold mine. We need to know the why. You need a field for the strategy applied and keep it to 1 per trade. Then, the reason for entry, a single line describing the signal, like double top on H4 with RSI divergence. But the single most indispensable element here is the screenshot or capture.
The visual evidence.
Yes, the image needs to be taken just before entry with your planned SL and TP levels marked. This reflects whether you saw the setup clearly. Finally, detailed notes on management adjustments. Did you move your SL to break even? Did you take partial profit early? This tells you how well you executed the trade, not just how it ended.
So the technical section essentially forces you to rate yourself. Setup rating, 1 to 5 stars, and execution rating, 1 to 5 stars. Did I follow the plan or did I improvise?
Exactly. Improvising is what separates the novices from the professionals. No serious institution, like the Fed or the World Bank, improvises their monetary policy. Traders shouldn't improvise with their capital.
From data to strategy and emotional insights. Once we have 50 or 100 trades logged, this mass of tactical and technical data, how do we turn that raw data into a winning strategy? What's the secret to optimizing it?
It's all about cohort analysis, using filters to isolate your edge. You become a detective. You must filter your journal by strategy, session, and asset. If you discover that your trades during the American session consistently lose money, the clear action is to stop trading during those hours. The journal doesn't tell you what to do, it tells you what to stop doing.
That's a massive takeaway. Can you give us a quick anecdote?
I once knew a bond trader who was convinced he was a great news trader. His P&L was terrible. When he filtered his journal, it revealed that 95% of his major losses came from trying to guess the outcome of a CPI release or a Fed interest rate announcement. He eliminated all trades 15 minutes before or after a fundamental news release, and his equity curve stabilized immediately. The data showed his weakness wasn't his technical analysis, it was his emotional impulse around high-stakes news.
Which leads perfectly to the third dimension, the psychological insights. Trading is famously 80% psychology. How do we document something as intangible as our emotional state?
This is the mandatory field I call emotional state and post-trade notes. This is where the journal acts as your therapist. Before entry, were you feeling euphoria from a winning streak? Were you under pressure to recover a loss? During the trade, were you anxious, watching the chart every 30 seconds? After exit, did a win trigger immediate greed to jump into the next trade?
That revenge trading impulse is lethal.
It is. I call it the law of the emotional interest rate. If you are running hot, euphoric, or angry, your risk of making a methodological error skyrockets. The journal is the minute-by-minute transcript of your internal decision-making process. It forces a pause for brutal honesty.
Practical application and conclusion. So, for our listeners who are ready to make the jump, what are the best tools? Should they stick with Excel or go with specialized software?
Start where you are most comfortable. Google Sheets or Excel is fantastic because it's completely customizable and free. You can program your own advanced metrics like profit factor and maximum drawdown. The disadvantage is the manual data input.
And for those willing to spend a bit more?
They should look at specialized software like TraderSync or EdgeWonk. The massive advantage here is direct broker integration. They automate the hard data import, freeing up your time for the crucial qualitative analysis, those psychological notes that the machine cannot write for you.
So the message is clear. The most important capital you have isn't the money in your account, it's the knowledge you have of yourself under pressure.
Absolutely. We need to realize that consistent profitability is a direct result of documented discipline and rigorous self-assessment. By maintaining a digital journal, you stop being a gambler and you transform into a data analyst of your own performance. You build the 4 pillars of professionalism: experience, expertise, authority, and trust.
That's a perfect summary. Guest name, this has been incredibly insightful and practical. Thank you for mapping out the roadmap to consistent profitability for our listeners.
My pleasure, host name. My final actionable advice: if you don't have a system, start right now. Make your very next trade the first one to be 100% documented. That's where real progress begins.
Fantastic. And that's all the time we have for The Edge today. Thanks for tuning in, and we'll catch you next time.